Hey there, everyone. Dave Keller here with Market Misbehavior, President and Chief Strategist at Sierra Alpha Research. Thank you so much for joining me here on my weekly show on StockCharts TV. I'll start off by apologizing. My whole family is sharing nicely. We're sharing good times, good food, and also the flu. So we're all kind of passing it around. So I apologize if I need a random cough break between here and the end of the video. But I hope the content still glistens and still shines for all of you, and it helps you make sense of these markets for sure. Today we're going to talk about 3 behavioral biases that you're probably falling victim to as you go through your daily routines. We'll talk to you about what those biases are, how they can manifest themselves in your portfolio, and what tools you can use on the StockCharts platform to minimize their impact. Now, to start off with, what are behavioral biases? Well, academics over the decades have categorized a number of different what we call cognitive biases or behavioral biases. And these are things that, based on how our brains are hardwired as humans, we evolved in certain ways to help us survive and thrive as a species. But I would say a lot of those things certainly don't help our portfolio returns and don't help us make very good decisions with our portfolio. And I would say the common theme with each of these 3 biases is that emotions just get have too big of a weight in your decisions, right? In a lot of our lives, in relationships, in what job we're going to take, in what we're going to read or watch, it's a lot of emotion, right? We are emotional beings, and that is part of what makes humans so interesting and so fascinating, is that we are driven by our emotions. But what most pilots would tell you is flying based on emotions is not a great way to survive and have successful flights. And I would say investors should think the same way. We want to approach our portfolio like a pilot would approach their flight. We want to plan things ahead of time. We need to minimize emotions as drivers in our decisions and focus on gathering evidence. So the 3 biases we're going to talk about. Number 1, confirmation bias, which is where we develop our investment thesis and then start to gather evidence, and instead of the other way around, which is a much better way of doing it. I'll show you an example where, if you ignored a clear trend in the markets with gold, you would have missed out on one of the great trades of 2024 and arguably so far in 2025. We'll talk to you about how confirmation bias, I think, could have been a factor in why you may not have held gold when you could have. Number 2 is narrative bias, and this is how we are drawn to stories or narratives. We sort of become wed mentally to a particular investment thesis, and then as a result, it's hard for us to think outside the box. I'll show you an exercise that I do on my YouTube channel, and that I do often with my own clients over the years to help nudge their thinking and encourage them to break out of their predetermined narratives, and hopefully something you can keep in mind going forward. Finally, endowment bias, or the endowment effect. This is where we hold on to things way too long, and when the charts no longer work, if the chart's no longer good and the stock is no longer helping our portfolio, we continue to hold on to it because of our emotional attachment to the particular stock or ETF. I'll show you 3 examples of stocks recently that I think demonstrate the way that you can overcome endowment bias and what signals on the charts would have told you to avoid those trades or at least unwind unsuccessful positions. All right, so we'll start off with the first one called confirmation bias. And I would argue, again, this is the most widespread that I've seen. And to demonstrate this bias, we'll talk about, the problem for most investors. And I'll show you my chart list, which is the monthly chart review. I actually just wrapped the monthly chart review for my Market Misbehavior Premium members. We do that the first week of every month, where I go through a set series of charts, applying my market trend model to a bunch of different ETFs, look at performance statistics, sector relative strength, really think about how the markets have evolved. And we do that because what I have learned is that too often we fall victim to confirmation bias, which is we make our decision. I'm bullish on stocks. I'm bearish on gold. I'm bullish on Bitcoin. I'm bearish on semiconductors. Then we start gathering information. And if you're looking at charts, but you're already thinking about what you've already decided you're going to do with the semiconductor ETF, your analysis of the SMH is probably not going to add a ton of value. All it's going to do is confirm that thing that you are already going to do. Excuse me. So by using the chart list feature on StockCharts, my morning coffee routine, my daily chart exercise is done with the chart list. My weekly flight plan, which is the weekly report I put out for my premium members, I use a chart list for that. And my monthly chart review, Not surprisingly, I use a chart list as well, because what I found is by going through a set regimented list of charts every day, every week, every month, I can really focus on what's changing. I can focus on what's new or what's different. And instead of just sort of, making the decision based on what I think should happen, by gathering the evidence first and then figuring out how I want to be positioned, that is avoiding confirmation bias, because it's an evidence-based analytical process, right? I gather evidence first, then based on the weight of the evidence, I make the decision. Now, basically, this is what my monthly chart review does, and we start with major equities. We look at asset allocation. We look at stocks versus bonds and commodities and currencies. Then we look at non-U.S. markets. Then we look at U.S. markets, and we finish at sectors. But one part of my monthly chart review, if I think of the last 12 months, has been remarkably helpful, and it's this part where we look at gold and silver and commodity prices. Here's the thing, right? If you look at year-to-date returns in 2025, so starting the clock at the end of last year and going through the current day's trading on Tuesday, February 4th, the S&P 500 currently up about 2.7%. We can see that here. The NASDAQ and small caps, the Russell 2000 ETF, are almost dead even at around 2.4%. Bonds are lagging behind a bit here, up about 1.5% for the year. But look at gold way up here, up 8.4%. Gold actually spent much of 2024 outperforming the S&P and the NASDAQ. So think about that, right? Even if you knew ahead of time stocks were going to have an incredibly robust 2024, driven by technology, growth stocks, the AI trade, one thing I would probably not think to buy in that scenario would be gold, because we often think of gold as a safe haven. So the confirmation bias would be gold's probably going down because it's a safe haven, and risk assets are doing really well because stocks and Bitcoin and other things are doing great. But for most of the year, gold actually outperformed because gold is actually not that good of a safe haven. It is sometimes, but it's less about moving inversely to stocks and more about a low relationship or an inconsistent relationship, which is so interesting. So that monthly chart review, every month, I'm looking at the performance table like this, or the performance chart, and I'm seeing how gold is consistently an outperformer. So regardless of what I think should happen to gold, the charts kept reminding me gold is a really good place to be. Even this month, as I'm doing the review, I'm saying, all right, gold yet again is outperforming risk assets. So let's look at the technical configuration of the GLD. This is a gold ETF. And full disclosure, I do own GLD in accounts that I manage. But if you look at the chart, you can see for much of the last 12 months, we'll call it from February through late October of 2024, a clear uptrend. And I think a breakout in August was a significant upside follow-through, kind of continued the uptrend phase that we saw in the first quarter of last year. Look how the RSI is consistently in the bullish range, so rarely gets below 40 on pullbacks, often gets to the overbought region above 70 on rallies. That is a chart in a primary uptrend phase. Look how that changed in November and December, right? The GLD pulled back, actually gapped below its 50-day moving average, and then established resistance here around 250. And we hit there a couple times in November, once in December, and then finally broke above there in earlier in January. You can see that the momentum was more negative there in November and December, right? The whole range of the RSI went from 40 to 80 down to like 20 to 60, right? Sort of bumped down a bit. But now we can see in the last 3 or 4 weeks, we've actually broken back into that bullish range as the GLD has broken above resistance, has now made a new high, and has pushed the momentum has pushed up into the bullish range. So the chart of the GLD, I would argue, in a primary uptrend, if you applied my market trend model to the chart of the GLD, it's fairly constructive right about here. So all things point to the chart is in a position of strength. Now, the reason why I think confirmation bias is so common with something like gold is because we often think of gold as a safe haven. You could argue this is an example of narrative bias as well. We'll get to that in a minute with a different example using the S&P. But I would say with gold in particular, what's interesting is if you look at the relationship. So there's an indicator on StockCharts called correlation, which I think is underappreciated on the StockCharts platform. You can say correlation, so whatever ETF you run this on, I'm running it on the GLD, I'm basically saying I want a 20-day rolling correlation to the S&P 500. So you can put whatever other stock or ETF or index on the left, put the number of days, and I usually do 20 because it's a month, trading month, and so that's a good number to start with. And you can see that just over the last 12 months, you can see times when gold and the S&P actually were doing about the same thing. For example, when gold rallied in early July and the S&P was rallying as well. So the correlation got very, very close to +1, which is the strongest, perfectly positive correlation. But you can see not too long before there, the correlation was around -0.3, which is, almost, dead neutral. You can see here there's actually a negative correlation all the way down to 0.75, negative 0.75 in late April because gold was coming off and stocks were actually rallying. We can see other times where the correlation is right around 0, right? Meaning there's literally no defined relationship between the two ETFs over the last 20 days. The reality is gold has what we call a differentiated return profile, which is a fancy phrase the financial industry likes to use to describe the fact that they do different things, generally speaking, right? Sometimes they move together, sometimes they move differently, but it's hard to have a consistent relationship. Something like the S&P and the NASDAQ, pretty consistent, strong positive correlation. So you would see the correlation kind of be up here in the 0.9 to 1.0 range almost all the time because they're so similar in their construction and their weighting to the mega cap growth stock. Something like gold and the S&P, very different return profile, correlation, which is actually quite fluid. So as a result, you can't assume that gold is going to go up or down based on the fact that the S&P is going up or down at any particular time. So what it tells me is to focus on the evidence, focus on the charts. And as we analyze the charts here in early February of 2025, I see gold in a primary uptrend with improving momentum, and overall it tells me to remain in gold as long as those trends persist. So confirmation bias is where we make our decision first, then analyze the chart. We want to remember, we want to analyze the charts, and I would encourage you to use the chart list feature on StockCharts. Come up with that list of charts that you review every month, every week, every day. Make a chart list where you start to build that list and literally go through there every time. Use the annotations to put notes on the charts, to draw lines, to remember what you're thinking at different phases, because that's how you're really going to understand when the evidence changes, which is an important way to minimize emotions in our decision process. All right, the second bias we're going to talk about is called the narrative bias. And the narrative bias is a fun one. Think about the narrative bias. My favorite example is like buying a car, right? When you go to buy a new car, and my most recent car purchase was a Tesla. And I tell you what, that was a weird car buying experience. Very different than any other car buying experience I've ever had. So eliminate that if you bought a Tesla. It's kind of weird and you buy it from your phone essentially, which is kind of crazy. But a normal kind of traditional car buying experience, you go to a dealer, you start talking to a representative, and what do? Do they sit you down at a desk and talk to you about your lease opportunities and talk to you about the size of the engine and talk to you about the type of leather used in the seats? No, they want to get you in the car, right? They want you to test drive. And the reason why they want you to test drive is because humans love narratives. The moment you sit behind the wheel and you smell the new car smell and you turn it on and you start driving, you picture yourself in the vehicle. And then from that moment on, your conversation with the dealer is about you already mentally in the car. You've already bought into that narrative of Dave, the new car owner, and now everything else has that as a starting point. So you're much more likely to buy a car and take a better deal from their perspective because you've bought into the narrative. So a narrative bias is where we basically have a story or a narrative that we're so tied to. And then when things happen differently, it's difficult for us to disconnect from our narrative. I've seen that a lot with recently, with the Fed and rate cut cycles. So, all right, when the Fed cuts rates, here's what normally happens. And then again, we've not completely followed that playbook over the last 6 months. So if you ignored the evidence of the markets and the charts and just focused on that narrative, you might have missed some really good opportunities. You could argue the example with gold is a good example also of narrative bias, because you buy into the narrative of gold isn't great when stocks are strong. And then, again, you ignore the fact that the chart of gold has been so consistently positive, and it's indeed outperformed stocks over the last year or so. But another way that I found this is with your market call or your market thesis. And you see that a lot on social media because people that are bullish, they tend to make fun of bearish perspectives. People that are really bearish tend to make fun of super bullish perspectives. And it's probably my least favorite part of the financial sort of Twitter X fin-twit kind of landscape is the antagonistic view with which many approach and describe other points of view. I think other points of view are fantastic because it forces you to disconnect from your narratives. As a matter of fact, in my Fidelity days, we would have what we called a bull-bear meeting. And if we found we were all in agreement on a particular stock like Apple, someone would volunteer to take the other side of the trade. So we'd go in and someone would make the bull case and the other would make the bear case. And even if we all agreed with the bullish case, it would force us to think about, all right, what's the bearish argument? People that are bearish on the stock, what's motivating their thinking? And by stretching yourself outside of your predetermined thesis, then you will be less surprised when the market does something kind of crazy, which it often does. This is an exercise that I'm showing you here with the S&P 500. I do this about once a quarter, excuse me, on my YouTube channel. So I most recently did this in early January, where we do what I call a choose your own adventure style video. We basically take the S&P 500, we take it from the current day, and this is the one we did back in late October, just before Halloween. And I laid out 4 different scenarios. A super bullish scenario where the S&P would go to 6,100 over the next 6 weeks. A mildly bullish scenario where the S&P goes up to around 5,950. A mildly bearish scenario where we pull back to around 5,650. And then a super bearish scenario where we break below the 200-day moving average, get down to around 5,300 or so over the next 6 weeks. And what I do in those videos is force myself to describe those 4 different paths. What would happen in the super bullish scenario? And we talked about resilient strength of the Magnificent Seven stocks. Some of those that have had incredible runs just continue to show strength into the holiday season, into early December. We talked about how rate cuts would be taken very favorably. We talked about an election that would be taken very positively in terms of the potential policy changes. And sure enough, if you look at the chart, scenario 1 played out almost exactly. This is the arrow that I drew in October 25th or something like that, and we almost exactly hit that point in early December when we got up to that point. So yeah, late October to early December. But I also thought about these other different scenarios. Excuse me. And number 2, 3, and 4 did not play out. But what I love so much about this exercise is I force myself to think outside of my predetermined, perspective. I remember, and I have to go back to the article that I wrote on my StockCharts blog, but I'm pretty sure I said the scenario 3 was the most likely one. And I tell you why, because we'd made a peak in mid-October. We'd pulled, started to kind of chop around a little bit, and it felt like that may be the beginning of a downside rotation. And so I think I sort of went with scenario 3 or maybe scenario 2 as the most likely. But what I loved about it was I also laid out, this is what scenario 1 is going to look like. This is what scenario 4 would look like, which meant when scenario 1, about a week later, when we had gapped down but then gapped right back up after the election, I was like, it looks like scenario 1's the one. And so we thought about, what does that mean? What types of things are going to work? What type of trends are we going to see? What momentum are we going to see? And all of that played out brilliantly. So while I didn't think scenario 1 was the most likely scenario, I'd already thought about it, and I'd stretched myself away from my current investment thesis to consider some alternative ones. So when scenario 1 played out, I wasn't that surprised. I'd kind of already thought about it and already thought about how I would need to change positioning, make sure that I'm fully invested, make sure that I'm looking for long opportunities, all of which I was able to do going into early December. So that choose your own adventure style approach, and I'd encourage you to go on my YouTube channel for some of those more recent ones. And again, we just did one at the end of beginning of January, mid-January. Keep an eye out for those, because I think they're helpful in that they force you to think about alternate scenarios. They force yourself away from your narrative just to consider some alternative points of view. So that's a narrative bias, how we get tied into a story. Think about different scenarios. This is what we call probabilistic analysis. Instead of thinking in terms of absolutes, like this is what's going to happen, so this is what my portfolio is, you want to think in terms of probabilities. These are all possible future paths, and this is what they would mean for my portfolio. This is where institutions is how we would tend to think, and I would encourage you to think along those lines as well. The final bias is endowment bias, or the endowment effect. And this is a tricky one, and I'm sure this will sound familiar, because the endowment bias is when You own a stock, it's doing well for you. All of a sudden, the stock starts to rotate lower and starts to underperform. Despite the fact that the price is no longer working in your favor, you continue to hold the name. And I will tell you, it's most likely because of an emotional attachment to that particular stock or that particular position. Has that ever happened to you, where you hold on to a stock way longer than you should, even though the price is going down? You ignore the change in trend because you just believe that this stock is going to work. I am sure on the other side of this screen, many of you are holding your hands up. I will do it as well. Happens to the best of us. So what happens with endowment bias, I would argue, is it's ignoring what the chart is saying. One of my mentors, Ralph Acampora, used to, I love how he said, analyzing the chart is the easy part. Actually doing what the charts tell you, that's the tricky part. And that is rung true for me as I think about my own career history and some of my misses holding on to stocks way too long when the charts no longer could justify it. I'll show you 3 examples of how I think you can minimize endowment bias. And I would say, number one, it's on the StockCharts platform. It's using alerts. It's using scans. Scan on your portfolio, right? Get your portfolio holdings into StockCharts and then scan for when they are breaking down, when they're showing sell signals, when they're breaking below their 200-day moving average. And while that doesn't mean necessarily you're just going to automatically sell, it does tell you something's different. This is a chart of Pfizer, by the way, and I have 3 examples to show you of where I think endowment bias may have hurt you if you held the stocks through downtrend periods, and what we could have done using the charts to minimize it. Pfizer was an exceptionally strong name coming out of the COVID low, right? This was Pfizer and Moderna. This was the COVID vaccines. This was like the golden age of those pharmaceutical companies. They were pretty much the hot topic as we saw the markets recovering, and it looked like Pfizer was going to dominate here. And in 2021, a remarkably strong year. But look at how the first half of 2022 was much more of a choppy sideways year. And then the second half of 22 into 2023, the stock completely broke down. For almost the entirety of 2023, the stock was in a confirmed downtrend. So many things from a technical perspective changed from late 2021 to early 2023. So if you held Pfizer during that period, you ignored the fact that the trend went from positive to neutral and neutral to negative. And certainly on the daily chart, we saw breakdowns of support. I remember vividly like these breakdowns where we, made a new low and then undercut it. Certainly showed a position of weakness when we failed to hold the 200-day moving average and failed to get above those 2022 highs. Was a very negative stretch. And then we went back below the 200-day or the 40-week as we show it on this chart. The momentum overall drifted much lower. So there are plenty of, technical signs that the chart was rotating. And I always talk about a line in the sand, right? Thinking of a level below which you decide to take action on a position. And I would encourage you with any charts of stocks and ETFs that you own, look at the chart, see what that line in the sand would be. What's that level below which you agree to reconsider the position? Set every one of those as an alert on your StockCharts account. Have the platform keep an eye on those for you. Have it email you, send you a text message, pop up with a banner on the screen, and then you won't miss it when one of your stocks is breaking down. So that's Pfizer with a clear negative rotation, kind of in the COVID era versus the post-COVID era, where things went very differently. Another thing I would tell you in terms of avoiding endowment bias is to focus on relative strength, right? I don't blame you if you held Microsoft for the last 6 to 12 months because the stock hasn't broken down, right? And I would say this looks like it was going to be a complex head and shoulders pattern kind of late 2024 because we had a high surrounded by lower peaks on the left and right side. We had a neckline here connecting the April and August 2024 lows, but we have never broken that. So, while the stock is no longer going up to the degree that it was in late 23, early 24, it's not really going down yet, right? So on an absolute basis, the position's not hurting you, right? It's not a great position, but it's not that bad on an absolute basis. You haven't lost any money owning Microsoft for the last 6 months, right? You're probably just flat for that period. But here's the problem. If you look at the relative performance of Microsoft versus the S&P for the last 6 months, you can see how negative that trend is. What that means is by owning something that's going sideways while the major equity averages are going up, you are underperforming big time. And what that means is while you're not losing money on an absolute basis, you are definitely losing on a relative basis. The problem here is the opportunity cost. If you know your economics 101, right? An opportunity cost is, not that this you lose on this particular thing. It's losing out on the opportunity to do something else. That is the opportunity cost because you're missing out on that other opportunity. The opportunity cost with Microsoft is very significant because the relative performance being so negative tells you a bunch of other stocks like Palantir and Meta and Alphabet and others are doing quite well. And so why not own those stocks that are doing better? So I found a lot of times individual investors get way too focused on the absolute returns. They forget about relative strength. So don't forget to scan on stocks in your portfolio with a relative strength breakdown. The final thing I was telling you is look for bearish momentum divergences. I think the chart of Synchrony Financial SYF is still pretty strong, right? We're making higher highs and higher lows over the last couple months. However, we can see a bearish momentum divergence. So while I probably would be okay holding SYF in a portfolio, if I did, I don't own SYF at the moment, but if I did, I probably would be okay holding it, but it would definitely be on a chart list of names, right? Sort of the red flag chart list, a watch list of stocks that are showing divergences that I want to closely monitor to see if we do break below key support. Now, I'd probably use 62, which would mean a break below 62 would mean we've filled that gap, or at least broken into that gap range and broken below the lows from November, December, and January. So, keeping an eye on a chart like this for a potential breakdown, given the fact that we've given that early warning signal, that's how we get ahead of endowment bias. And instead of waiting and holding on to it way too long, we now have the warning laid out on the table. We can now set an alert for when that stock would break down and then make sure we unwind it. Don't think another thing. You just close the position and move on to better opportunities. So there we go. Those are 3 common behavioral biases that I found working with a bunch of investors over the years: confirmation bias, narrative bias, and endowment bias. I hope that this video helps you understand those biases a little more. I think it's pretty reasonable why we are wired this way, because it comes from a good place, evolutionary wise. But I would say for our portfolios, they can hurt. And I hope especially you've learned how we can use the StockCharts platform, using the chart lists, using the alerts, using the scans, just using the fantastic technical analysis toolkit on the StockCharts platform to better minimize the impact of those biases on our portfolio. For Market Misbehavior, I'm Dave Keller. Have a great week, and we'll see you again next week. Bye now.